Good day, everyone, and welcome to today's Citizens Bank Global Markets webcast titled Managing FX Risk in Novel Times, a Framework for Success. This webcast will be 60 minutes long and is being recorded, so everyone will be in listen-only mode. At this time, it is my pleasure to introduce today's speaker. From Citizens Foreign Exchange Team is Director Eric Zarnfaller. For over 25 years, Eric has worked with CFOs, treasurers, and controllers in designing and implementing foreign exchange risk management programs. He comes to the bank with 14 years of experience in various corporate treasury roles. Most notable were from companies such as Fortune Brands, EG&G, and Hasbro, Inc. Along with this, Eric comes with 15 years of his foreign exchange consultancy experience at Bank of America before joining us here at Citizens Bank. Eric is a regular speaker at the AFP conference, and he graduated from University of Michigan and received his MBA from Pace University. Now, without further ado, please let me welcome Eric Zarnfaller. Eric, take it away.
Thank you, Patrick. Good morning, everyone, and thank you for taking the time to join the Global Markets webcast, Managing Foreign Exchange Rate Risk in Novel Times, a Framework for Success. Since this is not an in-person meeting or an interactive discussion today, if you have questions about a topic covered or want to discuss a specific issue concerning your company's hedge program, please reach out to your Citizens FX contact or to me after the webcast, and we can follow up with you. The next slide is the agenda for the presentation, which outlines the areas we will cover from identifying the exposures all the way through the implementation and review of a hedge program. Foreign exchange rate gains and losses impact financial results and external guidance. Therefore, they impact not only investors, but also internal stakeholders against their metrics. The goal at the top of the agenda is to understand the underlying foreign exchange risks of the business and to develop a hedge practice to mitigate the impact of this risk to the financial results. Okay, let's get started. The next section reviews the most important and sometimes most difficult aspect in managing foreign exchange risk: exposures, identification, classification, and risk quantification. The foundation of the risk management program is knowing the company's exposures in detail. An exposure can be defined as a business transaction denominated in the non-functional currency of the company and or its subsidiaries. A company's functional currency is defined by FASB as the currency in which the company does the majority of its transactions. This slide illustrates potential exposures and their location on a very simple income statement. When discovering exposures, the information can be gleaned in the financial reporting system, or you can ask the controller or subsidiary managers. For example, regarding sales, does the company sell overseas and in which currencies? Does the company have overseas sales or distribution offices? Remember, sales can change due to changes in exchange rates and can be higher or lower in US dollar value, but the risk also can be reflected in lower sales volume when compared to budget rates. Then we move down to cost of goods sold, and you may ask, where does the company source and in which currencies? Does the company have manufacturing sites outside of the US? Here, the FX risk on these exposures impacts gross margin. Then digging further down the income statement, are there non-functional currency items in other operating expenses, say warehousing, freight, or shipping? The FX risk on these exposures impacts operating profit. Then looking at non-operating items, does the company pay royalties or license fees? Does the company have foreign currency denominated debt that may be reflected in the interest expense line? And finally, there is the other income and expense line. This is where the FX gains and losses may be recorded when balance sheet exposures, for example, accounts receivable and payable, are remeasured at the end of accounting periods. Now that we've reviewed the income statement for potential exposures, let's move on to the balance sheet on the next slide. The balance sheet is where the recognized exposures are located. For example, accounts receivable, which may be related to sales, And then under liabilities, accounts payable, which can contain the sourcing costs and other non-functional currency denominated expenses. These two balance sheet accounts can impact the other income and expense line on the income statement with their related foreign exchange gain or losses, as we've seen above. Then, in the liability section, it may contain any non-functional currency debt the company holds. At the bottom of the slide is the accumulated other comprehensive income line in equity, which will contain the cumulative translation account. This account contains the mark-to-market of any net investment the company has in non-functional currencies, plus any impact from the translation of the financial statements back into the functional currency of the company, say the US dollar. I left on top of the balance sheet the cash account, only as a reminder that hedging will impact a company's cash flows, which may be a risk management program metric for some companies. These are just a few examples of exposures on the financial statements. When managing hedge programs, I found through my discussions with global finance managers that identifying the underlying nature of the business transactions, the details of what drives these transactions, what business risks exist impacting these transactions, and if these transactions impact a subsidiary's performance, is the base knowledge and guide to effectively managing the risks of a company. One time I was investigating a subsidiary that had third-party receivables in rubles. This balance sheet exposure was growing, but not at a significant rate. However, the remeasurement on the income statement was increasing due to the volatile ruble. When I dug down into the exposures with the regional manager, I found the makeup of the exposure was changing. The days outstanding were growing beyond 270 days. I was told by the internal credit department that the third party was having financial difficulties and only paying off current invoices. This was creating a larger than necessary variance on the financial results. The company used its long-standing relationship with the client to manage the days sales outstanding, to manage future sales terms accordingly, and then we hedged the exposure to mitigate the risk. When first looking at a company, you may ask, how do I identify these exposures and how can I forecast the exposures? Identifying the exposures can be done through the financial reporting system by linking the foreign exchange gain or losses to an exposure, talking to a business unit or subsidiary financial managers globally. As you are identifying the company's existing exposures, it is a good time to evaluate the information system or systems the company is using, as on the next slide. You can ask, what information is available? Can exposures be found by currency or in the local currency amounts? Can subsidiary information be reported separately? Do the subsidiary systems have the exposure information in detail? Or does Treasury need to reach out to subsidiaries to gather this information manually, which is not unnecessarily an uncommon practice. In the next section of the slide, we cover where forecast exposure information can be found and how exposures can be forecasted. There may be forecasts from the financial planning and analysis group, business units, foreign subsidiaries, where you can ask for sales forecasts, cost forecasts. You can even ask for forecasts of the payable and receivable balances if these are not available. You could extrapolate forecasted exposures from historic data and trends. Or you can extrapolate forecasted accounts receivable or payable from forecasted sales and cost data. To extrapolate any exposures from historic data, the underlying terms of the sales or payables and receivables need to be known. Any exceptions need to be identified, and also the overall business cycle needs to be confirmed. Is it consistent, cyclical, or seasonal? Now that we have a broad overview of exposures, both current and forecast, let's classify the exposures and dig a little deeper into the life of an exposure on the next slide. The top section of the page is a list of the 3 broad accounting classifications of exposures and where the FX impact will be recorded. The accounting classifications can also be used to broadly define the company's exposures when writing a policy. First, transaction exposures. This classification has 2 sub-definitions. Forecasted transactions, which will not be on the financial statements, and the FX risk impact can appear as a variance from budget or guidance. Then recognized transactions, which are recorded on the financial statements, the balance sheet, and which will directly impact the income statement. Economic and competitive exposures. Economic exposures can be generalized as the overall FX rate impact on the business after consolidation into the functional currency. Competitive exposure may be defined as the advantage or disadvantage the company has in selling into the market, where a competitor has the currency advantage in sourcing or selling in that market. The impact of the FX risk can be seen in sales, sales volume, and market share variance when compared to budget. Finally, there is translation exposures. These are the non-functional currency financial statements which are translated back into the functional currency of the company. The FX risk from this translation is recorded in the cumulative translation adjustment account in the equity section of the balance sheet. Most companies focus on transaction risk for their hedge program, but all exposures should be evaluated to ensure that the risks and their financial impact is understood before deciding which exposures to manage. Now, looking at the diagram at the bottom of the page is the life of an exposure. This is an example of a transaction exposure broken down into the 2 different risks. On the left is the forecasted risk transaction, and on the right is the recognized transaction risk. The exposure starts or comes to life at the budget approval point on the left of the chart. As time passes, the exposure flows along the green line through to the next point where the transaction is recognized on the financial statement. In other words, when a sale is made or the materials are bought and an invoice is sent or received, establishing a payable or receivable on the balance sheet. The first section can be defined as the economic risk of the exposure's life. During the economic risk phase, the exposure does not exist on the balance sheet, and there is no exchange rate remeasurement recorded on the income statement. However, the forecasted transaction may end up with a variance when compared against budget once recognized. The next section of the chart on the right, the blue line, is where the exposure is recognized on the balance sheet and will be remeasured against new FX rates each accounting period until the funds are received at the far right of the diagram. Once the funds are received, the transaction impacts the cash account, and the gain or loss from the FX remeasurement will impact the income statement. This part of the life of an exposure is defined as recognized transaction risk. The outline of the exposure's life assists with the development of the risk management program. In other words, which phase or phases of the exposure's life will be most important to the company to meet its metrics. The next slide covers quantifying the current and forecast impact of the exposures. The current FX gains and losses have been isolated already on the financial statements. The top section of the slide outlines verifying the current gains and losses against these actual results. The amount of the exposures are identified together with the respective FX gains and losses. Then FX gain or loss calculations are performed and verified against known FX impacts. The same process also can be used if there are hedges currently in place. The verification of the FX gain or loss calculation is a good check on the reporting system and understanding the current accounting practice. Also, the method or model to recalculate the exposure gain or loss can be used as a quick forecasting tool. Next, we touch on a number of ways companies quantify forecast FX gain and losses in the section of the slide, The method can change depending upon the underlying exposure being evaluated. For example, using foreign exchange Using forecast FX rates against the budget rates will give the company a view of what variance might occur, especially for forecasted transactions and guidance against the budget. Next, a simple percent move in exchange rates for future periods, say the 5 or 10% move theory, can give a quick snapshot for potential risks to the company. I have found that this may not always be the best approach. I was asked by a CFO how a percent move would impact the company. I knew that the financial planning area did this calculation of a very broad sweep across exposures in US dollar terms. I had improvised a simple income statement, like the exhibit on page 4, but tied to the exposures we were managing. I used current forecast exchange rates in the model against the exposures and came up with a very currency-specific impact rather than a broad percent move. My consolidated result was smaller than the percent move analysis as specific positions, short and long, were considered, and the individual currency forecasts were used. Even though this basically assumes a percent move in exchange rate, it was found to be more reasonable and directionally correct by management. Then there are more quantitative and statistical methods of calculating the potential impact of FX risks. Some companies use correlation analysis to analyze the different currency exposures against a proxy currency. This method can potentially reduce the amount of exposures hedged and the number of trades, and still mitigate a significant portion of the risk. The next example is a method for companies with more complex exposure profiles. This is the value at risk analysis as illustrated on the next slide. The example is a realized 1-month transaction exposure of 100 million euro and illustrates how the value at risk analysis creates a range of potential gains or losses in the chart at the bottom of the page. The value at risk used in this presentation is 1 in 20. Basically, the question from this analysis to be answered is the bolded statement on the middle of the slide. Does the company hedge a 1 in 20 chance of losing $2.7 million in cash based upon the probability of exchange rate movements? The answer lies in management's risk tolerance and the objectives of the hedge program. One of the benefits of the value at risk analysis is that this method not only quantifies the potential monetary impact, but it places the impact against a probability, or let's say a confidence level, that management can understand against the significance of the exposure. If you would like to delve more into quantifying risks, like the use of value at risk or other statistical methods, the Citizens FX team has the resources to help you analyze alternative methods to use for your hedge program. In summary, in this section on exposures, we have covered the types of exposures that could exist at your company, where the exposures are located, how the information can be found and forecasted, and the quantification of the potential risk to the company. In the next section, we will discuss defining the objectives and the benchmarks for our hedge program. On the next slide, we note the most important point in establishing the program objectives is to make the objectives achievable. Let's say choosing an objective to eliminate all exchange rate impacts on the company's financials may be an unreasonable and an unachievable objective. Risk management program objectives can differ depending upon the company's risk tolerance, if the company is a public or private, management's metrics, and how the FX risk is measured, say by US dollars or by a value at risk metric. These program objectives should be defined with all stakeholders of the exposures involved. In other words, if the exposure exists on a subsidiary's books and impacts the performance, the financial manager of that subsidiary should be included in the objective decision process. In the lower section of the slide are some examples of objectives the team has observed. Some companies want to minimize the impact on the other income and expense line, reducing the FX gain or loss that is caused by balance sheet remeasurements. EPS risk mitigation is frequently used as an objective for public companies and entails knowing and managing all exposures above the net income line. Some companies are in an industry that focuses on operating profit as a metric. Mitigating risk of EBITDA variance is a common objective for both private and public companies. Protecting cash flow is another objective for some companies in certain industries. This objective can also be important for companies with substantial long-term fixed contract business. In summary, the objectives will be defined by the exposures and management metrics. Also, the hedge program can have several objectives for the different underlying exposures managed in the program at the same time. Once the objective or objectives for the program have been defined, the metrics or benchmarks should be established. Our next slide touches upon some of the considerations and benchmarks companies use. Benchmarks are the quantifiable targets to which the hedge program is managed and also evaluated. The considerations are the business and program objectives which we have reviewed. The next section of the slide illustrates some benchmark examples. Planner budget rates can be a useful metric for economic risk and investor guidance and is a common benchmark. Some companies choose year-over-year hedge rates, which is useful for smoothing the program's impact and is another potential benchmark. However, this can be an important benchmark but difficult objective. Hedge program results may or may not be able to be replicated year over year. One time I took advantage to hedge euro out 5 years when the euro reached 1.30 or above. This created significant value for the company's bottom line for a couple of years, basically a few pennies per share. However, these gains slowly disappeared over time as the hedges rolled off and the euro weakened. New hedges with the same advantageous rates were not achievable. The next potential benchmark is a minimal zero impact on the other income and expense line. This is also a common benchmark, especially for managing EPS and EBITDA, and it is related to a balance sheet hedge program. Next could be a defined margin variance in dollar terms or percentage. A benchmark could be the variance of cents per share, as we've kind of reviewed above. Finally, you could use a value at risk management or percentage variance as a benchmark. As I stated before, a company can have multiple objectives. For example, the company is managing both balance sheet, with the metric being the FX gain or loss line, and forecasted transactions with the budget rates as a metric. In summary, in this section, we covered some of the considerations for developing both the broad objectives for the hedge program and the benchmarks or metrics commonly used by companies. In the next section, we review the hedging tools available, which should be defined and evaluated for inclusion in the policy. On the next slide, we discuss the appropriate tools, which can be divided into two categories on the top of the slide: business tools or decisions, and derivative instruments. Business decisions, like the examples in the first bullet point, can be used to mitigate currency risk. For example, changing the currency of invoicing on intercompany transactions, issuing third-party or intercompany non-functional currency debt, which can be useful as natural hedge, negotiating currency clauses in third-party contracts, or finding alternative suppliers. The most complex business decision is establishing new manufacturing sites or distribution channels. Business decisions are also important considerations when a company is entering into new markets or changing the legal entity structure, and should be considered first in the program. Once your business toolbox has been filled, it is time to turn to the derivative toolbox, the second bullet point in the top section. Derivative tools are forward contracts, option contracts, and cross-currency swaps. Forward contracts are the most frequently used tool for hedging realized transaction exposures or highly probable forecasted flows. The benefit of the forward contract is a locked-in rate mitigating any exchange rate volatility, positive or negative. The graph on the lower right of the slide illustrates the impact of using a forward contract. The unhedged exposure is the dotted line and experiences both a gain and losses depending upon the exchange rate. The forward contract, the solid line, fixes the value against any exchange rate changes. Options can be used for transaction hedges when the company is willing to have a reduced effective hedge rate, the strike rate adjusted for the premium, in order to realize upside potential. Options are also useful if the current hedge rate is out of the money against the benchmark and the forward view is in the company's favor. Forecasted transactions that do not have a high probability of occurring can be hedged with options. The downside risk is known if the exposure is not realized, as either the cost of the option, the premium, or for zero premium options, the floor strike rate. Cross-currency swaps are an excellent tool for hedging a stream of foreign currency cash flows like debt. It covers the FX rate risk and also utilizes surplus cash in foreign currency. Current cross-currency swaps are an efficient tool used as net investment hedges on the balance sheet. This can also be useful if the company is expecting to divest assets in the future to avoid any FX gain or losses. On the lower left side of the slide are listed some of the considerations in choosing the appropriate derivative tool. The choice could depend upon the exposures being hedged, the benchmark for the exposures, current market rates, and perhaps even exchange rate expectations, the accounting impact, potential tax impacts, and the company's risk tolerance. And if options are considered, the company may need to budget for upfront costs. In the end, keep the approved hedge toolbox as full as possible in the policy for flexibility in managing risk, and continuously evaluate each tool for optimum hedge program effectiveness for each hedge situation. In summary, in this section, we have reviewed both the business tools and the derivative tools to mitigate FX risk in the company. In the next section, we will cover the accounting treatment for FX exposures and hedges and their respective gain and losses. This can be an integral part of the risk management program's effectiveness. This discussion will cover the macro considerations for selecting or not selecting hedge accounting treatment on the next slides. The current accounting practices for the company have been defined during the analysis of the exposures, gain, and losses, and these can be reviewed later on in light of the program objectives and benchmarks. First, as noted on the slide's first two bullets, under ASC 815, under, let's say, the non-hedge accounting treatment method, the mark-to-market value of all derivatives is to be recorded on the balance sheet during each reporting period. And if a derivative is not designated as a hedge, the changes in the mark-to-market will flow to the income statement. Following these general accounting rules, the recording of the exposure impact and the hedge impact may be misaligned on the financial statements. In other words, the hedge gain or loss may not be recorded on the same line item as the exposure, loss, and gain, and the results in the program not meeting the stated objective. Sometimes this alignment is referred to as geography in hedge accounting. A benefit of applying hedge accounting is that it allows the matching or alignment of the gain or loss on the exposure with the loss or gain on the hedge on the same line item when the transaction impacts the income statement. Another benefit of selecting hedge accounting is that forecasted transactions can be hedged, and the interim accounting period hedge gains and losses are retained on the balance sheet in other comprehensive income until the transaction impacts the income statement. This reduces interim income statement volatility and allows for protection of forecasted flows. Under hedge accounting, there are three accounting designations listed on the bottom of the slide. Cash flow hedge designation, which can reduce interim income statement volatility. Fair value hedge designation, which can align the gains or losses on the same line item for balance sheet hedges, let's say. And net investment designation, under which the interim gains or losses remain on the balance sheet. To elect hedge accounting treatment, there are certain exposure qualifications that must be met, upfront documentation requirements for the hedges, and upfront effectiveness measurement, which is also conducted through the life of the exposure. We start with the cash flow hedge designation on the next slide. In order to qualify as a cash flow hedge, the exposure must be identifiable and quantifiable. The cash flow to be hedged must be denominated in a different currency than the functional currency of the entity that has the exposure. For example, a euro functional subsidiary can hedge its sterling denominated sales, but not its euro denominated sales. Then the probability that the exposure will occur must be high, let's say around 80%. And this probability must be maintained during the life of the exposure to retain hedge designation. The maturity of the exposure must be defined, but the maturity of the exposure may occur within a 60-day range around the designated maturity date. In other words, if the exposure is designated to mature on June 30th, to retain the cash flow hedge designation, the exposure can occur during the period June 1st through July 30th. So hedge accounting allows for some timing variances. Next, the upfront documentation defining the exposure and the amount, the risk hedged, the expected effectiveness, the objective referencing the main strategy document must be completed for each hedge. Finally, the expected effectiveness must be determined up front, and during the life of the exposure, it must be monitored. There are two methods for measuring effectiveness. The shortcut method. This is the simplest effectiveness test. It compares the gain or losses on the hedge and the exposure. For the hedge to be deemed effective and to retain the hedge designation, the gain or loss on the hedge must fall between 80 and 120% of the exposure's loss and gain. Then there is the long haul method. This requires a more quantitative analysis of effectiveness, usually using regression. I want to note here that the requirement to report ineffectiveness separately to investors has been removed for all hedge designations. However, effectiveness analysis is still required to confirm the hedge designation in order to determine if the total gain or loss of the hedge will flow to the balance sheet or to the income statement. The fair value designation discussion is on the next slide. This designation is not common, but can align the hedge gain or losses to the same line item as the exposure's losses and gains on the income statement. Fair value hedge designation has the same basic qualification requirements as the cash flow hedge designation. The exposure must be identifiable and quantifiable. The cash flow to be hedged must be denominated in a different currency than the functional currency of the entity, and the maturity of the exposure must be defined and can occur within that 60-day range. The upfront documentation is still required, but the main difference is that for fair value hedges, the measurement of effectiveness is not required. On the next slide, we review net investment hedge designation. The qualifications are mostly the same as for the other hedge designations, so I will highlight just the differences. First, there is no requirement to designate a maturity date of the exposure. But note that the hedge amount for the net investment hedge cannot exceed the net equity position of the subsidiary. For example, a U.S. company with a euro subsidiary, which has 100 euro in assets and 80 euro in liabilities, the net investment hedge by the parent could be 20 euro or less. The upfront documentation is still required, and the measurement of effectiveness is the long haul method. To note, recently, FASB acknowledged the COVID pandemic as a rare and extenuating circumstance and will allow companies to continue with cash flow hedge accounting, keeping gains and losses in accumulated other comprehensive income beyond the normal maturity date allowance we have discussed as long as the company can substantiate the extension as a result of the COVID pandemic and that the exposure is still highly probable. In summary, we have covered in this section the high-level aspects of choosing hedge accounting. There are more details related to hedge accounting that should be reviewed before deciding whether to elect it or not. Citizens cannot give accounting advice, but the team has significant experience as to the election of hedge accounting and its details. Citizens FX Desk also has outside resources available to review any questions you might have on the election of hedge accounting. In the next section, we will discuss the development of risk management strategy. The strategy will be the hedge guideline in the policy and will outline the exposures the company is facing, those that the company will actively manage, and the objectives and benchmarks to be met. This slide lists some of the considerations of developing the strategy. If the company elects hedge accounting, the level of detail described below may increase for documentation requirements. First, considerations. What to hedge? Here the company designates which exposures it will manage under the program. The description should be flexible to be able to adjust as needed and may be as broad as the accounting classifications we discussed earlier. Next, how to hedge. The analysis of the exposures will guide the development of the most efficient method to manage the risks, individually, netted, or as a portfolio. The strategy will also outline the maximum tenors of the hedges and the approved tools to be evaluated for hedge recommendations. Next, hedge execution may be centralized to Treasury or allocated out to an international Treasury center or to subsidiaries, or the company may choose to have all three execute hedges depending upon the exposures, local regulations, and experience. The policy may describe when the hedging is to be executed. This may be determined by the benchmarks or when the revised exposure information is available, especially for cash flow exposures, or at month end or quarter end for balance sheet exposures. Then it will cover how the program is executed in the sense of systematic approach, layering hedging in at specific times to increase the percent hedged, or dynamic, targeting specific rates. The strategy may also be a hybrid of these methods depending upon the exposures, objectives, and risk tolerance. This macro strategy, I can't emphasize enough, must be flexible when it is defined in order for Treasury to be able to adjust hedges and the execution against normal and volatile markets and business conditions. The next slide provides some examples Citizen has seen among its clients against the life of an exposure graph for transaction risk. Cash flow hedging on the left side of the diagram, the economic risk phase of the life of an exposure, has tenors that may range from 3 months to 3 years, with amounts ranging from lower percentage for longer dated exposures to higher percentages up to 85% for short dated exposures. Forwards and options are the most common tools used, and hedge accounting is typically elected to keep the interim gains and losses on the balance sheet until the transaction is recognized. Balance sheet hedging on the right side of the diagram tends to be more systematic and short dated, with terms of 1 to 3 months, and can reach a 100% hedge position. Forwards are the most common tool, and typically hedge accounting is not elected. In summary, this section reviewed the development of a top-level strategy to be documented and used as a guideline for the individual hedge recommendations for execution. It is now time to take all of this information and discuss in the next section the development of a policy and its procedures. On the next slide, the points to be included in the policy are listed as a detailed takeaway for you on your copy of the presentation, so I will not go through this item by item. These points within the policy have already been defined through the analyses and the discussions in the previous sections of the presentation. The policy should be the framework and guideline for the program's risk management recommendations going forward. One important aspect we have not discussed is the third to the last bullet in the list. Who approves each hedge recommendation? Is it the treasurer, the CFO, both a hedge committee that may include the treasurer, CFO, regional finance managers, accounting, and tax? The importance of this item is that if there is a sudden change in the exposures or in the market, like the pandemic or let's say Brexit, Treasury needs to be able to act quickly, which means the approvers need to be available to review hedge recommendations. How many times have exposures changed or there is a move in the market advantageous against benchmarks and no approval could be obtained in time and the opportunity was lost? Since Treasury cannot forecast all events, otherwise they would be on a beach with a computer trading, I found that if there could be a future event, I would outline this event to the approvers along with its potential impact to the company. And I would receive approval ahead of time to execute a hedge of this risk, even if the hedge would not be executed for several months. The approved hedge can always be changed or canceled if circumstances change. In the past 6 months, clients have been flexible with their hedging program, from reducing the amount of hedges and or shortening the tenors to temporarily curtailing the hedge program and assuming any market volatility through the income statement until confidence in the business forecast reached an acceptable level. The points on the slide are also the outline for the development of detailed procedures for the hedge program, which we consider on the next slide. This is another takeaway in the form of questions that I will not go through point by point since the basic material has been covered. But I will leave you with this remark made by an auditor to one of my colleagues on the desk. He said, "I should be able to walk into a company, get a copy of the policy and procedures, and be able to run the hedge program without missing a beat." This is exactly what the policy and procedure should be. Once put into practice, it will become self-evident what is efficient and what is not. If exposures are at the subsidiaries, then they will have reporting requirements of the FX gains and losses, and that may require that procedures need to be added locally as necessary. The procedures makes every process and every participant's role clear. In summary, in this section, both the policy and the procedures were discussed to be flexible and to be appropriately detailed guidelines to run a hedge program from exposure identification through review and report generation. In the next section, we reach the fun part of the program development: program implementation and review. On the next slide, the implementation of the program is illustrated as a three-step process. For a company new to hedging, this is when you take the plunge and execute hedges after all the exposures and risk analysis and quantification have taken place. If you have a policy and a strategy, you have the necessary information to outline the implementation. At first, the most significant exposures can be selected, and perhaps only a percentage of the notional hedged. A shorter time frame could be selected at first to test the program's effectiveness. As confidence and experience increases in the program, the amount hedged can be increased and tenors extended. This implementation method can also be used to introduce new hedge tools like options to the program or hedges for a new international business initiative. The hedged positions and unhedged positions should be evaluated monthly against the actual gains and losses to determine if the hedges are effective at mitigating the FX risks against the benchmarks and objectives, and can direct necessary changes in the program. Be flexible with the program when events happen like trade wars, pandemics, tariffs, and great recessions. Knowing the current value of the exposures and hedges and the ability to measure the future potential impact due to rate changes will allow the company to act quickly and to mitigate adverse financial impacts. After the implementation has been executed and time passes, the program should be reviewed periodically, as on the next slide. On the left-hand side of the slide are some correct questions we came up with to ask yourself about the program. For example, did the program meet the benchmarks? If not, why? Are the benchmarks the correct benchmarks to meet management's objectives? Were there any unknown exposures? I think this may not be unusual. I had an experience when I was in the office of a company early, around the start of my career, reading the newspaper. The CFO came in and asked me what was going on. Frankly, I did not know what he was really asking as I was reading the paper. I answered, "What's going on?" Then he asked why they were losing the margins on a large sterling multi-year contract. I looked up and answered, "What contract?" The end result, that there should have been better two-way communication about exposures between Treasury and the business division regarding FX risk. Because of the strength of the pound and some speculative positions taken on at that time by, let's say, a single investor, the company almost lost all of its profits on the contract when the pound abruptly depreciated. Finally, ask yourself what changes can be made to the risk management process. On the right side of the page are what are considered incorrect questions. Are hedges in or out of the money is not the correct question to ask or judge a hedge program. The efficacy of a program is the net impact of the hedge against the exposure and meeting the stated benchmarks, the upfront stated benchmarks. The direction of currencies is also not a solid question unless you are trying to beat the market, which is not a very commonly acceptable objective. This was an objective you may not want, as I had this objective in one company, and I had many long days and nights trying to accomplish that objective. Finally, I found that the review of the exposures, especially forecasts against actual, was the most critical point in the review process, and I conducted this monthly and for every new forecast. I asked why there were changes in the exposures or if the FX impact significantly was different from what was expected. And I looked for changes in the underlying business for clues to the changing exposures. This gave me a better understanding of the business risk and trends the company was facing that could impact the hedge program down the road. In conclusion, we hope that this presentation has been helpful for companies new to hedging and for those companies which already have an established hedge program as a review. In risk management, knowing the risks to the company and quantifying their impact is key to solid risk management. A flexible risk management program, including all stakeholders in the company, can add value to managing both internal and external expectations, and actual hedging the risks can provide more stability to financial results. If you have questions, please reach out to your Citizens banker, to your Citizens FX contact, or to me. The Citizens team has significant experience in hedge program alternatives for your company to assist with your risk management analysis. Before I let you go, on the current slide, you will find a sample of our FX publication, The Fix, our website address, and contact information if you do not already have an FX representative. Please visit our website for further information. And again, please reach out with any questions or if you would like to explore the topics presented here in more detail. Thank you again for your time. It was greatly appreciated.
Thank you, Eric. Ladies and gentlemen, this concludes today's webcast. The replay link of today's presentation will be sent to all registered participants. If you have any questions or would like to speak further on this topic, as Eric has mentioned, please contact your Citizens Bank relationship banker or your FX representative. If you enjoyed today's session and found it to be helpful, please stay tuned for upcoming Citizens Bank events. Thank you so much and have a great rest of the day.